Every day, every single day, things are happening in the world of deals and deal makers. And there's never enough time to keep up with every company, transaction, announcement, or whatever. It's just exhausting. And we have a new product to help fix that. This is Axios Pro Deals, a new premium subscription product bringing you tailor-made insights like never before. For the last 5 years, Axios has helped deal professionals navigate the whole deal landscape with Pro Rata. With Axios Pro Deals, we're diving deeper into the industries that matter most to you. You just want stories on fintech? There's a newsletter for that. MedTech deals? We've got you covered. The future of retail? We'll guide you. With Axios Pro Deals, you're going to be getting all of this industry-specific insight and expert analysis at a level you simply can't get anywhere else. So if you're a venture capitalist, private equity investor, banker, trader, founder, executive, anyone who cares about deals, Axios Pro is what you need to help you understand what matters and why. Start your free trial today at axiospro.com.
Welcome to our next installation of this year's Dealmaker series, The Road Ahead for Private Companies. I'm Keiko Kalicheva, Technology and Business Reporter at Axios, and I'm coming to you from San Francisco, California. Welcome to our audiences on Facebook, YouTube, Twitter, LinkedIn, and on Axios.com. Join the conversation today on Twitter with @Axios and hashtag Axios Events. Over the next 30 minutes, I will be joined by my colleague Dan Primack. We'll explore the issues around the current market for private companies and why they may be choosing to stay private for longer. So our first guest today is Sequoia Capital partner Pat Grady, who's joining us from Menlo Park, California. Pat, welcome.
Thanks for having me.
Awesome. Well, we're going to jump right in. And my first question is about this latest warning that you guys issued to your portfolio companies and really the industry. You guys made a similar warning at the beginning of the pandemic, your famous Black Swan memo, which turned out to be a little bit off base. And I guess you guys kind of overestimated how little help the government would give America. So why do you guys think that this time your predictions about the rough times ahead are going to be correct?
It's a great question. So let me frame it quickly. So we have been in business for about 50 years, which means we've been through technology platform shifts. We've been through economic cycles. We've been through generational transitions. We've been through any number of crucible moments. And so when the world starts to change and our founders are starting to wonder what they should do about it, they come to us with their questions. So we had this presentation a couple weeks ago, which we called Adapting to Endure, where we basically convened our founders and provided a forum in which they could ask the questions that were on their minds. To answer your question, what is different now versus the Black Swan memo from a couple years ago, or even RIP Good Times from 2008? This is distinctly different in that the most powerful economic machine on the planet, which is the Fed, is now on the opposite side of the table from us. So in 2008, 2009, the Fed had a stimulative economic policy, monetary policy coming out of the global financial crisis. In 2020, when COVID hit, the Fed wanted to stimulate our way out of impending recession. The Fed is now trying to rein in inflation. And so what is very different this time versus last time is the stance of the Fed. And that's something that in general is going to be working against a lot of the companies in the tech industry.
And so can you give us a couple of the connecting dots between what Jerome Powell is doing in DC and your average entrepreneur and his company?
Yeah. So when people say inflation, that's kind of an abstract concept. Translate that into the price of gas. So somebody was spending $100 to fill up their tank last week, might be spending $200 this week. That's $100 of stuff they can no longer buy. When people say interest rates, translate that into mortgage payments. Somebody who was paying $1,000 a month last year might be paying $2,000 a month this year. So these are real costs to consumers, and their spending is your revenue. And so if you're a startup, the assumptions that went into your model last year that were good and valid last year because they dealt with the reality of how people behaved last year may not hold true this year. And when we talk about things like, for example, the internet bubble burst, that sounds like a moment in time where all of a sudden overnight something burst, but it actually plays out over a couple of years. And so the ripple effects of what's happening at the moment probably have not yet been fully felt. And so our overall message to founders is not one of red alert. It is one of disciplined growth. And as we head into this new environment, you probably want to hear the word discipline a little bit more than you hear the word growth.
Speaking of disciplined growth, one of the tragic kind of consequences we've been seeing is a lot of layoffs from companies, big and small, and mostly big. Um, Explain to us why so many companies are doing these mass layoffs. Why does it feel like they should have known that the boom times were boom times and should have managed their growth in a more sustainable way? Because it's really tragic to be seeing so many people having, losing jobs, getting offers rescinded.
It is tragic indeed, and I think we need to look for examples like companies like Airbnb, which a couple of years ago had to make some hard decisions when COVID hit their business, and they did so with empathy, with compassion. They made sure that people landed on their feet coming out of the company. I think that's a good example for any founders who might find themselves in a similar position today. But the cycle of rebirth is one of the things that characterizes the technology industry. It's one of the reasons why the startup ecosystem is so vibrant. And even as there are larger companies making hard decisions, we're seeing smaller, newer, younger companies getting going with every bit as much vigor as we've seen in past down cycles.
I mean, even Airbnb kind of later admitted that it's sort of over. I don't know. I don't want to say overreacted, but it just felt like they were preparing for something that didn't quite come. And so I guess I'm just curious why does it feel like companies just overstaffed in sort of a irresponsible way? Um, but I don't know if you have any insights into that.
Well, I mean, economics is all about the marginal dollar, right? So when you're in an era of abundance, which typically means a low interest rate environment where money is reasonably plentiful, you're going to invest the incremental dollar. When you head into an era of scarcity, which means a higher interest rate environment where money is reasonably harder to come by, you're not going to be able to invest the incremental dollar. And so the investments that people made over the last decade that were perfectly rational investments for that period of time are all of a sudden not as affordable as they once were. And so this is why we see a lot of people reevaluating their spending plans, really leaning in on things like product and engineering and trying to be very disciplined with things like sales and marketing and some of the back office functions.
Shifting gears a little bit and let's talk about VCs. Right now, it feels like everyone's talking about, a slowdown, sort of a step back, a wait and see. But at the same time, the industry has record amounts of dry powder. New funds were raised last year and the year before that. Why does it seem like it's a little bit of folks kind of not wanting to be the first to make the move and maybe misprice an investment or, just make the wrong decision and everyone's sort of just looking around at each other?
I'm not sure I understand the question. Could you reframe that, please?
Yeah, just sort of what's your take on the slowdown from VCs? Or is there a real reason for folks to be taking a pause? Or is it more of just hesitation because they don't want to be the first to go in and make an investment?
I think the VCs in this case are the tail of the dog, not the head of the dog. And I don't think it's the tail wagging the dog. What I mean by that is, I think your average growth stage founder looks at what's happening in the public markets and says, I don't think I would like if that multiple was applied to my business and I've been able to raise so much money over the last couple of years. Maybe I'll just wait it out. And so I don't think it's inactivity on the part of VCs so much as founders looking at what's happening in the public markets, realizing that it's going to have some influence on the valuation for their companies, and just deciding to wait it out because they have the cash to do so.
Interesting. What about companies that don't have the cash to do so and that maybe were planning on fundraising this year and now have to make some decisions? How do you predict those companies will what do you think they're going to be doing in the next 6 months?
Yeah, no, that's where we see things changing in real time. And so the further away you are from the public markets, the more insulated, so to speak, you are from the valuations of the public markets. And so for seed and early stage companies, we haven't really seen pacing drop at all. For some of the growth stage companies that are closer to the public markets, the pacing has definitely changed, which is probably a function of what I just mentioned. And the terms are starting to change. And so the terms that were popular in that era of abundance that we're coming out of are starting to get tightened up a bit, and pricing is starting to adjust a bit to reflect the new public market reality. So we are seeing things change in real time.
Um, Another thing that people are talking about a lot, as you mentioned, discipline, but also people are talking about how profits are, back in fashion and better unit economics and sustainable businesses and all that kind of stuff. Talk us through why it feels like there's sort of a swing back and forth over the years. There's periods where it seems like VCs don't care as much about that, and then there's periods of more like austerity where, oh, we got to look at all these metrics and profits.
It's related to technology cycles and it's related to market cycles. Are somewhat independent, but as technology plays a bigger and bigger role in our world, those two things become more dependent. So if you look at what's happened in this last wave, last 15 years or so was basically the rise of cloud. I mean, that's accounted for the majority of the market cap. People didn't understand the cloud business model 10 or 15 years ago because it was a very new thing. And as a result, they viewed it through the lens of more of a traditional enterprise business. And in doing so, they probably undervalued it. Now, as people became more and more familiar with that business model, they started to draw the line backward. They didn't necessarily have to go all the way to free cash flow. They could start to look at some of the leading indicators of free cash flow, all the way back to something that was basically just product usage, and go all the way from that to someday will produce free cash flow. I think when you start to put these layers of abstraction between the thing that you actually care about as an investor, which is the ability to someday produce cash, and the thing that you can observe in the moment, that's when valuations start to get detached. And so I think what we've seen over the last handful of months here is valuations are getting reattached to economic fundamentals.
And we're almost out of time, so I'm going to ask you a very quick question. When do you think the tech IPOs are coming back?
It is always a good time for great companies to go public.
Fair, said like a true VC. Thank you so much, Pat, for taking the time to be with us today.
Thanks for having me.
And next we have a view from the top with my colleague, Fabricio Drummond.
Thanks, Kia. I'm Fabricio Drummond, Axios Chief Business Officer. Thank you to our sponsor, Cooley, for making this conversation possible. I now have the pleasure of hosting a conversation with Rachel Profit, partner and head of San Francisco corporate practice at Cooley. Rachel, welcome to Axios.
Thanks for having me. It's a pleasure to be here.
Thanks for joining us. Rachel, markets in 2022 have been nothing short of volatile. You advise companies and investors as they look to transact. What perspective from an insider's vantage point can you share with us, and how does it compare with what we're seeing in the broader trends from the market?
It's a great question. So I think it's fair to say that all folks are deeming the capital markets virtually closed. Public markets are just not a place where folks are going to raise capital right now. What I can share is that for the first few months of the year, I think there was a real healthy optimism that this was going to be a short-term problem, and that all we needed was, another week or two and another big IPO to sort of break the trend that we were seeing. That did not happen. Here we are nearly to the second half of the year, and I think the reality is that most IPO planning has paused. Many of the processes have been pushed out, and what we were hoping was going to be a lot of Q3 and 4 deals is now likely going to roll into 2023. Not all doom and gloom for sure. Absolutely money continuing to be raised in the private markets. Obviously, many large funds continuing to close on their own funds. And from where we sit, while capital may be being deployed more slowly and with some valuation sensitivity, it certainly is still feeling reasonably healthy in the private markets. But again, it will bode well when the public markets open up again.
Given private markets valuations are a lagging indicator of public market health, what do you make of the trends that you're seeing right now?
Yeah, so often lagging indicator, I think for most part, we think it's caught up a bit. Obviously for the better part of the last 24 plus months, our private markets were absolutely enjoying the ride, right? Being valued off incredibly high valued public company comps and feeling as if there was no end in sight to the way that folks could continue to succeed in this way. But it's certainly the case now that valuations are softer, terms are becoming a little bit more structured. Again, when we hit March of 2020, I think there was absolutely a concern that we might fall off a cliff. And I don't think, again, that anyone's particularly worried about the cliff, but I think everyone's doing a little bit of breath holding to see if, in fact, we are going to be entering a phase where there is going to be a lot more structure in these financings and where we may, in fact, be talking more about down rounds that, again, we haven't had to experience in the last several years.
And then as we zoom into industries, do you see impacts varying across industries on the broader market?
Yeah, I mean, from a broader market perspective, there's always the companies that are going to be in or out of vogue depending on where we are in the economic cycle. Biotech, fintech, I think, continue to enjoy up valuations. Again, maybe not as high as they were historically, but still healthy. We're seeing a little bit more of a struggle in the enterprise or consumer tech space. Generally speaking. And then again, it would not surprise anyone to hear that there's still a lot of money going into the blockchain, renewable energy, marketing tech, et cetera, on a global level.
And then as you're advising investors, interacting with them as they're looking at transactions and opportunities, have you seen any impact in investor mindset in this current market?
I think you can absolutely feel a tone shift. A couple of anecdotal examples, a couple of big name funds and incubators have shared, almost tomes of ways to consider running your business in these challenging economic times. And frankly, no one knows what's coming. And so I think this is, words to the wise from folks that have been there before. And I think it's also really interesting that this is happening because if we think about the last time in our economic cycle that we've had to deal with this, I suspect many of the entrepreneurs haven't had to endure a market like this in their professional careers. And many folks have not had to manage and run businesses through them. So it's probably sound advice to be shared. But we are absolutely noticing the tone and tenor of conversations in the boardroom, really focusing on operational efficiency, really focusing on when we really need to raise capital and should we try to wait out a bit longer and be more efficient with our on-cash reserves. And we are also noticing when folks do in fact need to go into the markets to raise capital, that the investor conversations are a little different, right? The Uber-friendly terms from a founder's perspective may not be as present, and investors are absolutely focusing more on sort of downstream economic protections in a way that they may not have been in historical years.
You touched on this, boardrooms and management teams are reviewing plans and orchestrating new strategies and exploring opportunities to stay private longer. What are some of the strategies and tactics that you have seen companies employ to stay private longer?
So there's always gonna be a question of, how long your investor base will allow you to stay private. And I think that really puts a lot of tension on the conversation around liquidity. If you look back again, 12, 24 months, there was just a clear path, right? If you weren't going to be acquired, capital markets were open and there was an opportunity for near-term liquidity. And I think expectations have been really set in that regard. And so what we are doing a lot of advising on now is folks, trying to figure out if they need to restructure their cap table to provide early investors, kind of replacement investors to get cashed out, doing a lot of advising on secondary liquidity for employees who, again, likely had expectations set that an opportunity for liquidity was coming in the near term, for the mortgages and the and the college tuitions and all of the things that people are beginning to life plan around with the closing of the public markets and M&A valuations being lower, that just isn't on the near term horizon for many companies. And so we're spending a good deal of time counseling folks about ways to offset those expectations with some capital in a responsible manner, right? Because of back to the expectations of the investors and the folks sitting around the board table. The focus first and foremost is on business health and extending runway as long as you can, and then you have to manage with the talent that is supporting those organizations in the near term.
Excellent, Rachel. Thank you for joining us and for such an insightful conversation.
Thanks again.
Thank you, Cooley, for making this conversation possible. Dan, over to you.
Thank you, Fabricio. I'm Dan Primack, business editor of Axios, and I'm pleased to be joined now by Harvey Pitt, who is the CEO and managing director of Kalorama Partners and the former chair of the SEC, joining us from Washington, D.C. Hi, Harvey.
Hi, Dan. How are you?
I'm great. So maybe though better than the markets are, public-private markets right now. So let's just start by getting your lay of the land. Are we heading toward a recession in the next year or two, which obviously is something every private company would have to be cognizant of?
I believe we are at the beginning stages of a recession already. The economy is tanking, and I think many of the policies of the current administration are exacerbating that status.
Give me what's the one, if you were in charge, if you were in the White House, in the Oval Office, what would be the one policy right now you think that could either reverse the recession you think we're at the beginning of, or at least depress it?
I think we have too much spending going on, with more being proposed by the administration. I think we need to cut back on a lot of our expenses and get the government out of many aspects of everyday life. We need true capitalism, not our move toward European versions of socialism.
So, okay, let's talk about true capitalism, of course, so in the private markets, we have really for the past decade seen this incredible bull market, more than anything we've ever seen before, at least in terms of valuations and the amount of money companies from startups to more mature, particularly in tech and biotech, have been able to raise. Do you think that things got too hot? In other words, are we in a recession right now just because of things you said, or did things just get way too hot and way too inflated? And this is more a correction than anything else?
A lot of it is a correction. You're absolutely right in that regard. And our economy is basically causing people to take a very pessimistic view in the markets. And so we're seeing really wide gyrations and a great deal of volatility that is making it very treacherous for investors, particularly institutional investors.
Yeah, it's interesting. When I think of investors, particularly in private companies, there's a couple different categories, and one of them almost kind of indirectly becomes the employees of these companies, particularly if they're startups. People get stock as part of their compensation, they vest, and that becomes part of kind of their net worth. Used to run the SEC, and one of the SEC's goals or purposes is investor protection. Is there anyone out there who protects the vested startup employee in terms of their stock?
Well, one thing, Dan, is that the SEC's mandate also includes an obligation to facilitate capital raising. So in a sense, although investor protection is job number one for the SEC, certainly facilitating capital raising is essential. What we're seeing right now is that there is almost a disdain for startup companies, for small businesses, mid-cap companies. And of course, there is also somewhat of a disdain for financial services entities as well. We need to have a more balanced policy, one that encourages capital raising and returns our markets to the strength of the world that they used to exhibit.
Well, I'm curious, venture capital funding, for example, last year hit an all-time record, and the only year it beat was the year before. So 2020 was a record, 2021 was a record. So why do you say there's disdain for startups vis-a-vis capital raising if they're raising more than ever before?
Well, those are private companies, and those entities are doing their normal job. But given some of the activities, including at the SEC, its proposed regulation of so-called private funds that are catering solely to highly sophisticated investors, and its rulemaking on SPAC transactions, there is a great deal of current reluctance for companies to go public. That means that private venture capitalism is working, at least when they see a good opportunity, but that the marketplace itself is shutting down to many of these startup companies.
And you guys, just to clarify, so you feel that the reason, particularly for the last, say, month or two, that we've seen so few IPOs or companies going public, whether via IPO or via SPAC, you feel that's more policy driven than just the fact that the market's pulled so far back and there's been a lot of volatility?
Yes, I think a lot of that is driven by the regulatory approach. I think many people are sitting on the sidelines saying, let's see what these companies start doing before we put our reputations and our liability on the line.
What would you do about SPACs? What the SEC is talking about right now, there's a handful of things, but the most important potential change that they've been discussing is really normalizing what SPAC or companies being de-SPACed, going public via SPAC, are able to share in terms of forward-looking projections versus what a traditional IPO issuer is able to disclose. Would you not do what the SEC is doing in this case, which is basically normalize both of those, say it's 2 years out and no further?
I think the SEC has correctly identified a problem in that many of the SPAC transactions we've seen included overinflated projections and were misleading to the people who invested in them. I think that's a serious concern, and the SEC was right to act. The problem we have is what the SEC has now done is to say that it will treat SPAC transactions as if they were IPOs and bring all of the requirements of an IPO to a SPAC transaction. There has to be a middle ground, and I'm fairly concerned that the SEC may not have found it.
Do you feel, you've obviously been on the SEC for quite some time now, do you feel when you look at the agency that on the enforcement side, does it have enough tools? And I guess I'm asking in the context, to a certain extent, of Elon Musk, and not about what he is or isn't doing vis-a-vis Twitter, but it seems that even if the SEC wanted to throw the book at him, it's not a very big book, for at least compared to what they're throwing it at.
Well, I think the SEC has a great many enforcement tools, and I think it has enough to do the job. I think with respect to somebody like Elon Musk, he is unfortunately someone who will constantly test their mettle and their resolve. I think he thinks it's a game. He acts in a sort of narcissistic, juvenile way, and I think the SEC will have to deal with that. But on the other hand,
Can I ask though, can I ask, how would you deal with it? The SEC, I mean, they can ban people from being officers of public companies, or they can try to, but usually it's financial, right? They usually fine somebody or agree to a fine. The SEC has never fined anybody nearly the amount of money that would impact Elon.
I think that's right. And his violations appear to me to be, in some cases, deliberate, but they're not, shall we say, hanging offenses, okay? His efforts to take over Twitter involved him filing the wrong form and then filing the correct form late, to the detriment of many investors. This is simple and easy to deal with, and he has a ton of lawyers on his payroll, so he could easily have complied. I think he just plays games and taunts the SEC because he dislikes them.
What you do now, among the other things you do, is advise companies. And to go back to the beginning of this conversation, when you said you think we're already at the early stages of a recession, what is the kind of generic top level advice you're giving to companies right now, particularly when it comes to things like spend?
One of the things we're telling companies is measure your disclosures carefully. Be on the lookout for difficult situations that may be developing, and try to deal with them internally and keep your shareholders informed. We're moving to a point in time when disclosure violations are going to take on even greater significance, and companies can avoid that liability by having great disclosure processes at hand.
Harvey Pitt, thank you so much for joining us today.
My pleasure.
Thank you all for joining for this conversation today, which has made us all smarter, faster. For more news on the latest deals, please sign up for Axios Pro Rata, the daily newsletter that Kia and I write each day at axios.com/newsletters, or sign up for Axios Pro, our premium news subscription service for VCs, private equity, and M&A at axios.com/pro. Thanks again for joining, and we'll see you all on axios.com.